Good afternoon or good morning, everybody, and welcome to another FinTech Nexus webinar. My name is Peter Renton, Chairman and co-founder of FinTech Nexus. And today we are honored. We have an all-star panel here to talk about one of my favorite topics, digital credit. We're talking about the challenges and opportunities of digital credit. The fact is, community banks and credit unions have to transform if they want to compete in this new digital world. And what we're really going to be talking about here, we're going to hit on lots of different points. We are going to be talking about the challenges, the new challenges that have been created by the digitization of credit. Where we're going to go through some real life examples. We have a credit union and a community bank on this session, so we're going to get some real examples of how they are managing transformation inside their organizations. Of course, we're going to address credit losses in a potentially recessionary environment that may be coming, and much more. So with that, I want to hand it off. We'll do some intros for the panelists. Manish, why don't you kick us off?
Hey, thanks, Peter. Really excited to join the panel. I'm Manish Gupta. I'm CEO of Corridor Platforms. I founded it approximately 5.5 years ago with two other senior American Express colleagues. I spent most of my career at American Express in various roles, one of them being the Chief Risk Officer of the consumer business through the Great Recession. And I was also very involved throughout in helping transform Amex's decision management capabilities to support the needs of digitization. Corridor think of Corridor as a state-of-the-art decision intelligence platform, which is meant to help banks upgrade to advanced analytics and real-time decisioning capabilities, but do so in the most efficient means quickly and cost-effective manner. Idea was to take all of our experience and learnings and then leverage automation so that a small trained team in smaller banks and credit unions can be brought up to speed to compete on an equal footing with national banks or more sophisticated fintech lenders, this we believe is going to be key in the coming years, especially in a digital world. We are already in production at two large banks and a few digital lenders, but recently we launched a hosted version of our solution called riskdecisioning.ai in partnership with Oliver Wyman and EXL. Vikas is here from EXL, basically to expand our services to the next tier of banks and credit unions. Thank you.
Okay, thanks, Manish. Jill?
Hi, I'm Jill Castillo, President and CEO of Citizens Bank of Edmond, a one location, 55 team member bank located in central Oklahoma. We're about $375 million in asset size. Our largest shareholders are employees stock ownership programs. So the 55 team members are the owners of the bank. We're also one of the nation's few certified women-owned banks in the nation. And so we try to be really innovative, but we're also a really traditional community bank.
Okay, thanks, Jill. Richard?
Hello, my name is Richard Wada. I'm Chief Lending Officer at Patelco Credit Union. We're 470,000 plus members based in the San Francisco Bay Area, about 10 billion in assets. I've been the Chief Lending Officer for about 5 years here, and we do all types of lending. Prior to this role, I was at Citibank for a long run of 17 plus years. In the retail banking business in North America and globally. At Patelco, we do everything from mortgages, home equities, commercial lending, all types of consumer lending, very diverse portfolio. And that's been a focus for us, diversifying our portfolio into a variety of asset classes.
Okay, and last but not least, Vikas.
Thank you, Peter. Hi, everyone. This is Vikas Sharma. I lead our banking analytics at EXL. EXL as a company, we are focused on using data to drive business impact for clients, and we focus primarily within the banking and financial services space.
Okay, so let's kick it off. Manish, I want to start with you. And, it's in the title here, the challenges and opportunities of digital credit. Let's start off with the challenges here. What are the new challenges that have been created by the digitization of financial products?
Yeah, that's, I think, a critical question because digitization is now, commonly used term. So I'm not going into what it really means and everybody understands what the consumer expectation of digitization in banking and credit is. But what is truly new that would really impact banks? And when I think of digitization, two words come to my mind. First word is choice. This is the fact that consumers now have choice to apply for products and services across many banks and credit unions, and then accept the one that they like. Now, this is different from when we were managing credit or credit products or banking products traditionally. It usually somebody would apply for credit to our banks, usually when you have a deposit bank, apply for a mortgage or an auto loan or a credit card. And we would focus on approval rates and making sure we can give credit to most. And then we would expect the person to take the product and use it. Now you can apply for that same product. Let's just take an example of term loan to 4 other people simultaneously on the internet and choose the best offer after you've been approved. That creates a new challenge, which was not there before. So I want to highlight it, even while managing consumers. Because at this point, when somebody is taking your offer, is it because they truly believe that nobody else wants to give them the price that you're giving because they know more about this person? Or is it because the bank offering it is more sophisticated and truly realizes the potential? So there is this concept of competitive adverse select that is starting to become very, very prevalent. And therefore, if you are competing with more sophisticated players, the chances are that they are picking off the best consumers and saying no or pricing higher to the ones that they don't want. And you have to be very careful as you win, that you're winning with the same amount of sophistication, same amount of knowledge, same amount of data and analytics, so that you're truly creating a competitive portfolio. And these things, I think, become very important when there is a recession, because when losses are very low, all of the problems in a portfolio are hidden. But as soon as losses go up, and they haven't for a long time, and we'll talk about that later, I think it'll become clear on which portfolios are more at risk, and that could be a huge challenge. So I'll stop there, and then we can reflect on other things. I'll let other panelists also jump in.
Anyone want to jump in? Okay, we can move on to the next question. That is fine then. So maybe let's move on to consumer expectations, because that, clearly with the digitization of credit, that, as Manish sort of just laid out, I mean, expectations are going to change for consumers. They now know that they can apply for multiple offers, get approved, and then make a choice. Maybe Richard, you could start off with this one. Like, how have consumer expectations for credit changed over the last few years, particularly from a community bank / credit union perspective?
Yeah, that's a great question. Clearly, expectations have shifted quite dramatically, especially in the post-COVID era. I'd like to play a bit off of or add to Manish's comment about choice. Pre-COVID, and I think for many community banks or smaller credit unions, a lot of our interactions with members were in branch or face-to-face is our engagement model. But now we're in an environment where through digital access, our members and borrowers have a vast array of choice out there, and not just choice, but incredible speed to transact, which presents a very meaningful challenge for any financial institution that has historically relied on branch distribution or face-to-face interactions to build its business. So for the last 5 years, we've been on a very purposeful path to transact where consumers or borrowers want to transact. And that is really led with information and upping our game as it relates to meeting borrowers when the need arises. So reaching outside of our captive branch distribution channels, and expanding our direct-to-consumer activities through much more sophisticated use of information, propensity models, and targeting to reach our members and a prospect universe when there's a high propensity to transact. So that's been a very, very important journey for us. It starts, I mean, very fundamentally with how you curate your data warehouse, how you leverage your data, how you build models, et cetera. So that's been a dramatic change for us, is leveraging our information infrastructure and how we mobilize that information. For some perspective, in the 5 years that I've been here, we've migrated about from 25% of our origination volume on a dollar basis from digital sourced to 40%. So we've been very purposeful. Not only does that serve our members in a digital era, but it also provides tremendous efficiency for us in scale. And that's really the second thing that's really fundamentally changed for us, is just the sheer speed of transaction and the customer expectation that this needs to be easy. And so we really are looking to create a member experience that is sort of at par with fintechs, which has meant taking as much of the friction or the burden off of the member or borrower, and finding systemic ways to eliminate stipulations or document requirement verifications, et cetera, to provide instant decisioning and straight through processing, where we're eliminating the manual touch, so that any time of day, any time of week, a borrower has access to fund their loan with minimal, I should say, manual intervention, and they can transact when they want to, where they want to. And that continues to be a very big focus for us. Our systemic decision rate has increased from about 40% 5 years ago to, even in this recessionary climate, we're at a 55 to 60% systemic decision rate. And of those approved systemic decisions, we're at 85 to 90% straight through processing with no verification or doc requirements. And those are benchmarks that we're really looking to uphold, even in a recessionary climate, while managing the risk and pricing for the incremental risk with the expected stress in the environment.
That's impressive. Very interesting. So, Jill, I want to turn to you, and I want to talk about digital capabilities, because we were chatting before we went on the air here, and you said that you have 2 people in your IT department. You're not a large bank, but you don't consider yourself to lack in the innovation department. So I'd maybe you can sort of give us a sense of how a small community bank is able to launch new innovative products. You can talk about your new military digital bank if you'd like. I know that's launching soon. Maybe you can give some guiding principles for other community banks who are in sort of the early stages of this digitization journey.
Yeah, I'm happy to talk about that. I think the first thing that we have to do, and it's the hard thing because it's changing kind of an internal culture and business model, is that we have to really do things from the inside out. If we're going to automate and be relevant and innovative externally, we have to be doing those things internally as well. I remember our first journey was trying to go paperless internally, and it was a 5-year process because the culture just would not allow it to happen. We finally had to move locations, leave the big filing cabinets down the street, and make it so inconvenient to get access to paper that we had this drive towards the digital piece, and that laid the foundation for so much more. So you have to take those hard, kind of less sexy steps to make it where both you're able to have internal processes that are automated, but also have access to your data, know where your data is, so that then you can actually start building off of it. Whenever you're starting to do more kind of partnerships with fintech or developing your own things, it's so important to have those right partners. And the partners can be great, and you can be aligned kind of from a culture or mindset standpoint, but maybe maybe you have a disconnect from a compliance standpoint. Everything kind of has to be working well, and you have to be really in a partnership to be able to be a small community bank, to be able to launch something really new. And so really having the investment in the time, not just in the agreement, but the time with your fintech partners is just so important. But then you can also kind of go off on your own whenever the resources are very small. So if it costs not very much and doesn't take very much time, and there's not a big regulatory hurdle to overcome, then go lean into those types of short wins. We have a patent pending on a small business ATM where it's all digital branch. And it costs us about $60,000 to put that whole thing together and in about a 6-month time period. So if you can do something fast that's impactful, that also has very little resources associated with it, lean into that. If it's complicated and it's going to draw regulator scrutiny or cause potential privacy concerns, stay away from those types of things and look for really solid partners to move forward.
Interesting. Anyone else want to chime in there?
No,
I do.
go
Sorry, go
ahead.
ahead.
No, I think I was going to agree that leveraging automation and newer technology where fewer people can really do the work. In my experience, I think when we were in banking or the bigger banks, I think that at this point, there are too many people there, and a lot of processes are manual. And I think we were speaking about this, one of the benefits of automation is not only having fewer people do the process, but also getting that process right. So a lot of the errors and mistakes that happen in banking, which cause regulatory issues, are because of manual handoffs, which usually take a lot of time. So in this case, I think the win-win is for almost the whole industry to embrace automation, especially across compliance and governance, which is a heavy duty function, to make sure we are not making mistakes respecting privacy, data privacy, and other kind of fair lending laws, but doing it in a way that there's zero error. And I think Jill's talking about taking a small team and effectively doing that with automation and technology and across the field. And I think that is probably the future for all banks.
And one thing we don't talk about very much is the talent required to be able to both accept technology and change and be able to implement it. And so for us, it was also not only upgrading systems and automation, but really upgrading talent and having a team that could drive change and question the status quo.
That's a good point. Vikas, I want to turn to you, and I want to talk about the data-driven approach to winning customers, because let's face it, you're a small community bank and or credit union. You're facing competition from the big banks, from the fintechs. Often, online, you're just one click away from losing out. So, how do community financial institutions, how do they leverage a data-driven approach to win the right customers and build a profitable loan portfolio?
Thank you, Peter. So there are a variety of ways in which we see our clients using data-driven approach. We typically recommend a crawl, walk, run approach to them, Peter, right? So in the first phase, in the crawl phase, we typically will focus on activities which can focus more on acquisition, create a big impact. Like, for example, precision targeting, using data to go and pinpoint on the customers that are gelling well with your message, with your brand, and then being able to acquire new members at an affordable price. Especially using more digital channels, right? We see a lot of community banks traditionally have focused on using direct mail as a big source of acquisition, or using branches as a big source of acquisition. But some of our clients have started leveraging digital capabilities to go and do that in a very, very effective way. And then also being able to go and engage with more Gen Zs, millennials, which are typically much lower in age compared to their traditional member base. The other part which creates a big impact also is in terms of creating optimized pricing strategies. Right? So this enables you to go and basically compete with what fintechs might be offering or what some other bigger banks might be offering, and then using the data that you have to be able to go and create that affordable price point, which is attractive to the end customer. When we go to the walk phase, this is where we typically work with clients into making investment into their data foundations, right? So we typically see that many banks struggle with many different systems, and then they don't talk to each other. And then for them to create even a customer 360-degree view is a big challenge, right? But once they go and overcome that challenge, then it starts feeding into a variety of processes, right? It improves your in-branch experience. When a customer walks in, you're able to go and serve them better, but also it starts feeding into a lot of your analytic strategies and models as well. And then this is where we also work with a client around personalization, right? So understanding the customer lifecycle stage, where they are, and then how we can use data and analytics to go and give them the right product, right services. In the run phases, where we start actually working with clients to go and look at their core system capabilities and then start making them future ready, right? So this is where we'll start talking to them around, are they using any cloud capabilities, or even using more of the machine learning and AI in some of the processes that they have, so that they can start becoming much more efficient, much more targeted. Even if you look at some of the traditional processes like a risk or a marketing, so we start making it a more trigger-based approach. So when they see increased risk, how do they engage back with the customer? Or when they see certain kind of behavior in their checking account data or in other transactions, how they can start reaching out to them with other marketing products. That becomes a way for them to start becoming more relevant and then being at the right place to offer the right product to their end customers.
Makes sense. Okay. Manish, I want to turn to you, and I want to talk about the credit recession, and not just an economic recession. You've been at you've been in this business for many decades, as you shared, and you've seen different economic cycles, different cycles when it comes to access to credit. Can you maybe just hit on some of the main points here? How do you manage risk when we haven't had a credit recession for a long time? Access to credit has been flowing freely with interest rates so low for what, 12, 15 years now. What is, looking back to past cycles, maybe pre-financial crisis, what's your guidance on what advice do you have for managing risk in managing the risk of having a credit recession when many people working in credit departments have never seen one?
Yeah, and so it's funny because I know the panelists here are fairly experienced, so this is quite a unique question being asked at this moment, because when we were managing credit post the Great Recession, credit recessions would happen almost on the clock, every 4 to 5 years. So when you were growing banking or credit, you were always kind of trained. As you became a little too loose or effervescent, then suddenly there would be a recession and you would pull back, and you went through that cycle. And like you said, we've had no real credit recession for the last 13 years. That's the longest in the history of our kind of credit in the world. And I think it creates very, very unique challenges. One, there has been so much bias. So let me go into a few. One, there's so much bias in the current economic trends and data itself, because they're highly influenced by governmental and economic and financial stimuli. And so losses have been at a sustained low loss rates. When just before the pandemic, when losses rates were just going back to normal, people thought that was a recession, but we were just going back to like normal loss rates, even for prime. And then again, after the pandemic, there was so much monetary inflow into the system that they went back again, and now they are going back again. This is, to me, people used to tell me, when is the next recession coming? And I kind of stopped saying it, because I would always sound like an alarmist that it has to come. It's kicking the can down the road, which means, when it does happen, I can already see loss rates moving up. And I do believe the credit recession finally is going to come. Hopefully it won't be that severe. That it's going to impact a lot of banks. One, like you said, there are teams here who've never actually been in a recession, who really feel like, they can do a lot of things, and it doesn't really impact loss. Losses are running at prime portfolios sub 1. And that's not going to be the case. In all our life, prime losses were close to 3%. And then it would go to, I'm talking about prime portfolios, forget about subprime. And then in a recession, it would go to 4 to 5. And in the Great Recession, when it went to 10, 11, 12%, hell broke loose. And I can see that similar things could easily happen. We already spoke about how digital portfolios have choice and they have adverse select. So if you're not sophisticated, there may be inherent risk. People have also started using machine learning and AI, and depending on it a lot through outsourced tools. And these are good things to do, but AI and machine learning are very pattern recognition driven kind of mechanics of math. And they're looking at data which is not really predictive of the future. So a lot of our current credit scores, et cetera, are relying on this suppressed loss data, low volatility data. That can be a real surprise going into the future. So the question is, what do you do when it happens? I think for some part, you learn how to handle recessions by burning your hands. And I think there will be a lot of burnt hands during this process. And we'll talk a little bit about how that would create a challenge, but also an opportunity. But my only guidance to people is just don't rely so much on the past. Be prepared for the future. Think about how models will not, anytime we've gone through recession, whether they were sophisticated math or not, models become very weak in a fast changing environment because they don't calibrate fast enough. That's where human plus data and intuition becomes key, right? This whole question of AI modeling will handle everything. That's not true. In a recession, you have to start making changes based on your intuition. Where do you tighten? Where do you loosen? Where do you take an opportunity? Testing and learning is very important. This whole thought process of using automation to be very nimble in making changes in rules, adjustment in prices, and in production without having governance issues. Some of the things that we kind of are trying to automate at Corridor, that's going to be key. But so it's going to be a mix of intuition, learning, burning your hands, and then obviously when the dust settles, which I can tell you there's going to be a lot of people who are going to get hurt. There's also the great opportunity. But instead of me going into the opportunity, I really wanted to throw it back to Richard and Jill because we've kind of stepped out of banking. But here's my preamble to that. Whenever there used to be a recession, one of the regular practices in most banks would be, let's freeze growth. Let's freeze acquisitions. Let's just get a handle of things and we'll ride it out a bit. To Richard's point, the other second point that I never made on my first comment of digitization is speed. Right now, you saw how digital deposits move so fast during the current crisis. The same thing can happen to all of your good loans and credit cards. As you go into trouble, everybody is wanting to come and say, I'll give you a better rate to your good guys. So before we would say, let's not grow the numerator, we have the denominator. Now the denominator is going to shrink very fast because Richard is going to come after them saying, hey, all the good guys, let me tell you, this is not a very high loss rate bank, come to us, and people are going to be very skittish. And you know what investors are doing to make even everybody more skittish. So at this point, there is a chance also of being opportunistic. If you are sophisticated, you have your ducks in a row. When people get into trouble, how do you take the best customers and win loyalty? And you can also win loyalty on your current customers by making sure you do X amount of things. But I've spoken a bit, and I'm happy to go on and give lessons learned, but maybe throw it out to Richard and Jill on how could you use this as an opportunity? Because I'm sure I know how they think. They're thinking about how they will use their own digitization and automation and capabilities to make this a win for them. Throw it back to you.
Jill, you want to respond to that? Richard, you can have a turn as well.
Okay. I think you're on mute, Jill.
Yeah, Jill, you're on mute.
Yeah, I'm happy to. Thank you. Yeah, it's, recessions are difficult time periods, but they're the time where bankers should be shining because we're supposed to be experts, risk managers. And this is, assessing so many different components of the economy, different customers and how they're being impacted, and being able to pull all those levers at just the right time so that you're able to take advantage with the minimal losses, but then able to serve and expand your community that you're serving well. This bank was a troubled bank during the financial crisis. So I inherited a loan portfolio that was terrible. And so we were not in a position to take advantage of the situation. I can tell you from that standpoint, if you're in a position where you can't kind of control and you don't get in these positions where you can be in growth oriented mode, how you treat people during a turnaround or during the workout, it's such a great opportunity to prove who you are as an institution. It doesn't mean that you have to be super benevolent with individuals financially, but how you treat and are able to reduce the shame during those interactions will really create a lot of social capital going forward. And so I think that's one of the great pieces of a recession or kind of challenging credit environment is that you have the opportunity to really use it to your favor by pulling information about your customers, either that being on the boots on the ground and that experience, or being able to look at the analytics and be able to make decisions quickly of how to serve the community best. I think accessibility is also exceptionally important. And it's something, even as Richard, when he was talking about his question, as far as expectations from customers, especially in times of crisis, expanded accessibility is incredibly important, both from accessibility of digital information, but also call centers. We just expanded ours to 24/7. So you can have a live person that's answering the phone 24/7 to talk to them. I give out my cell phone number for use to all customers. So having a kind of breaking down the walls of the bank is incredibly important to have that accessibility. So you're able to, both in the most recent kind of reputational crisis that we faced in banking, creating calm in the storm, accessibility and consistent communications really combats that well. But also as you go into more troubled kind of conditions, to be able to talk about the condition of the bank, as well as what you're planning to do for borrowers going forward.
Richard?
I thought those were great points, Jill, about an opportunity to step up for your brand and your institution before its customer base or membership. And I think that, similarly, Patelco Credit Union, we're member owned, right? 470,000 members. And our intent is to continue to provide loans to the membership, albeit at I would say, with the tweaks to our credit models and verification processes that Manish was alluding to, which requires a certain extent of nimbleness. I'd add on to the fluidity of the rate environment, which combined with expected losses creates some complex modeling when it comes to an ROA expectation and how you should price for the incremental risk in order to earn a favorable return to the institution. But our intent is really to grow at a high single digit level. I think to Jill's point around the recent sort of banking crisis, which is expected to expand to community banks, it's really important that we maintain our lending facility while we continue to gather deposits. It's a show of strength from a liquidity perspective. We manage our balance sheet effectively and have the liquidity. So it's not about liquidity risk. It's really about managing the credit risk and stepping up as an opportunity to really strengthen our relationships and lending into our member base. We are also doing some things on the back end in terms of portfolio monitoring. We've increased our sophistication to look for early signs of stress, including total amount of debt exposure that our borrower base has, including not just our own loans, but exposures across their bureaus, and looking for certain critical thresholds, which is then triggering for us some proactive outreach, even though these borrowers may not be delinquent yet. As a credit union, we just offer such an array of deferment products or skip-a-pay products that could help ease a burden or transition a member from a temporary moment of crisis without causing damage to their bureau, which could have more dire consequences coming out of a recession. So certain practices that we're putting in place, but really look at it as an opportunity to solidify our value prop around taking care of our members.
Okay. Yep. Go on.
I want to add to a little bit to this point as well. And then I think Manish rightly pointed out, right? All those AI ML models or even traditional models, they take a little bit time before you can change them, right? So we actually recommend three things to our clients. The first one is make this a data-driven decisioning. Right? So we recommend them to implement some kind of economic monitoring framework. This could include some of the obvious things that everybody is monitoring, like unemployment or housing prices or something else, but a lot of things within your portfolio itself. I think Richard talked a little bit about a very interesting trigger that you can look at, or on your portfolio, you can look at the performance, you can look at the level of debt that they're carrying, and that starts giving a sense of how much pressure is there in the economy, right, and how it impacts your portfolio. The second part that we recommend is around basically creating a recession framework itself, right? So basically your playbook on when, and it's important not only to think about it in terms of credit tightening, when things are going bad, how can we go and quickly take actions? Particularly important in terms of reopening as well, right? So when do we see signs of recovery, and then when we can start going back to our members and then start giving them more access to credit. And the third thing here, Jill, it's a learning for me today, hearing from you, but I think now it makes obvious sense. I think the customer experience part of it, accessibility part of it, I think it's probably the most important part of it, right? While we might have the framework and the strategy, but how do we execute and how do we basically make it feel like it's all beneficial for members? I think that's the most critical part.
Right. That makes sense. So just a reminder to everybody, if you have a question for our esteemed panelists, now is the time to type them into the Q&A button. We'll be getting to audience questions shortly. Richard, I want to go back to you if I can. I want to talk about this, the build or buy question that has, that has been around, banking now for many years. What's your advice, and what are some of the tips you can provide the audience about when you're looking at sort of how community financial institutions can keep up with with the trends in analytics and technology? How do you think about it when you figure out, how do you decide what you want to own and what you want to rent or partner from companies that are in specific niches?
That is something that, well, that's a big one. We've been really methodically looking at all of our core capabilities in light of this rapid transition to a much faster digital economy and an information-based economy. And, I think that's a good exercise to determine what's sort of non-negotiable as a core capability as a financial institution that really needs to be proprietary to us in order for us to compete and succeed against fintechs, against big banks, against the competition. And so we've looked at sort of augmenting some of our core capabilities with the best of the fintechs. So I'll give you an example is when it comes to removing the burden of document verifications or income verifications, right? There's an obvious play there to use a fintech like Plaid or Finicity, where based on a member permissioned interaction, we can capture that information seamlessly and without any human intervention. And that's helped us to create a faster, more efficient processing experience. And we've decided that we really want to own the member experience. We think that's absolutely critical. So owning the processing and servicing is important. Another example is we've partnered with a personal loan fintech, but their model is typically to service their loans. What these fintechs do extraordinarily well is to market. We could never market at a scale that some of these personal loan fintechs can do. And having originated billions and billions of dollars, they have a tremendous amount of learning to leverage, from pulling through the funnel to credit performance, et cetera. So we're leveraging that, but yet we're onboarding these loans into our core platform so that we can service that member, have access to the performance information in real time, understand the migration and credit performance, et cetera, et cetera, which builds our intellectual competency around how this particular asset class performs, and especially by a leading originator in the country. So we're kind of using it to augment some of our core capabilities. I think one of the biggest ones we're struggling with right now is the credit model itself. We're a fairly large credit union. We're 25th largest in the country, I believe. But yet we don't have as much of the transactional volume and learning that some of these other larger institutions, big banks or fintechs have. And so there's one side saying, why don't we outsource the credit decisioning to one of these AI ML institutions and recognize a 5–10% lift on approvals without any kind of incremental lift on losses. And that sounds very attractive. But to me, it's kind of a bit of a devil's bargain, because I look at it like, isn't that core to what we do? And it's not just about the acquisition, right? It's how do we use information to provide the best fitting loan products from price, eligibility, line amount, et cetera, perspective, not just for that one transaction, but through the life of the loan, further extensions of credit. On the collection side, should delinquency become an issue, and then on the repeat purchase, and having all of that information in-house, augmented with our own overlays, be it relationship, alternative data, et cetera, and fight that battle of trying to build up our own credit models because we think it's that important. So that's a debate that's going on right now. I'm curious to hear what others think, but I'm very loath to kind of give that one up, because I think it's so core to what a financial institution does, is leveraging its information access and its member transaction data and behaviors into an ongoing relationship.
Right. So Jill, someone from the audience has actually asked you that direct question. So I'd love to have you follow up, like how you see banks like yours partnering with fintechs.
So there's no shortage of partnership opportunities. And I think that that's what makes it really overwhelming for small community banks that don't have a lot of resources. So it requires a high level of engagement from the entire senior management team, when you don't have like a chief innovation officer that's really surveying what are the opportunities out there and is able to sift through what the best opportunities are. And so for us, it's really creating a culture that we're seeking how we can be better. And you have full engagement of the senior team and even well beyond that, and assessing what are the opportunities in the environment, who are the players in the environment, and then pursuing potential partnership opportunities. The partnerships, so there's such a difference between signing an agreement with a core or some long-term player in the banking space and in a financial technology company, like truly someone that's more earlier stage. And so you have to have variance in your contracting as well. And so it's very important to have legal expertise accessible to you that's used to working with less sophisticated partners. Additionally, we always have if there's a less seasoned partner that we're working with, you want to have outs available to you. So with a core, you might be handcuffed to longer term contracts where you can't really negotiate specificities in the contract and agreement. That's not the case when it comes to financial technology firms. You have a lot of flexibility, and the more the power is shifted to you. And I think as community bankers, we're not used to having that negotiation power. And so to be able to use it, to have outs, so we typically will write in that in 90 days or 6 months that we have the opportunity to leave without any financial risk. The partnership is not working. This would be early partnerships, not necessarily how Richard was talking with like a Plaid, something that's more acceptable into the ecosystem. For those types of kind of more mature fintech, but not quite the core seasoning, and there's still some flexibility there. And I think one thing that's really important that oftentimes, again, you don't have as a community banker when you're dealing with seasoned financial technology firms and having earlier entrant financial technology firms, is that you really need to be able to get to the C-suite of those financial technology firms, of fintech. You need to know the CEO. You need to talk to the founder. You need to have their cell phone number. That type of accessibility should be in place because you're truly going after partnerships. And I will say too, that the investment in that time and that relationship pays out in spades on the back end. So if you're able to have someone that you align with from a value standpoint, that you understand what each one of you is trying to get from a relationship, because in fintech partnership, it's going to be very mutually beneficial, not just someone providing a service to someone else. as a small community bank, you can often be used as an entrance that a fintech is having to a small community bank space. And so you have a little bit of power from that standpoint. It's really important to invest in that relationship. So then as you have challenges and a product that gets launched that may not be perfect, that you're able to provide feedback. And I think that's one of the great upsides to fintech partnerships is you get to be part of building the user experience. You get to be part of the decisioning. You get to be part of the back office development. It's a voice we've never had with the cores that we're able to have whenever you're entering the fintech space.
Interesting. Okay.
So let me
Okay.
add to that, because having been on both sides, and in fact, this is the reason to be for Corridor, right? Because having been in big banks for almost all our lives, we started the fintech just exactly to meet the points that Richard and Jill are making. So I heartily kind of support their thought process. In fact, here is the view that when we were building stuff at, let's say, American Express, or that's where I spend most of my life, we would not want to partner mostly with anybody because we thought everything is core and we would build everything. And I changed that view when one of the reasons to kind of leave a good cushy job, hardworking but cushy job, and start a fintech was to kind of think through, okay, what is it that is core, but what is it that banks should outsource? Because fintechs now can focus, be nimble, be responsive, and be ahead of the legacy technology infrastructure, which banks cannot move fast enough. And when we were kind of upgrading to big data or real-time decisioning, it took us so long with mistakes on working with regulators that I thought, how would small banks and credit unions kind of even think through the process and the automation? That's when I thought, we thought that, hey, there's a need for a platform. And this is not a plug, this is my true belief, because we kind of did it, right? We said, why don't we think about how do you create automation and put all of our learnings in decision management so that the core decisioning, which is what Richard talks about, the data, the analytics can be done with the same level of sophistication, same level of governance. How do you take automation and give the smaller banks and credit unions, smaller relatively, the ability to do it with fewer people, more economically, not have to spend the hundreds of millions of dollars that the first initiators, movers did? And I think that is core, because when you're talking about digital, like Richard said, it's not about one underwriting model. It's customer management, understanding all of the data. It's not one product like term loans. It's going to everything. Rocket.com is the largest issuers of mortgages. So everything is going to go is digital. So that core, understanding the data, understanding your customers, doing your own decisioning, using all of your data is going to be the difference between winning and not surviving. That's how stark it is going to be. And therefore, using fintech platforms and automation platforms and decision management platforms to quickly get up to speed on the infrastructure and the automation, and then hire the few people that you can really rely on to continuously evolve is the key. Mm-hmm. And Richard and I have had long conversations on this, and that is our main goal in kind of enabling as we think about the future of fintechs and banks.
Makes sense. We're going to get to a couple more audience questions before we do, Vikas. I want to ask you a question about demographics, because it's no secret that the community bank credit union customer base it skews a little older. How do you attract and retain a younger, digitally savvy population? What are some of the things that community banks and credit unions can do to kind of engage with that customer base?
And that's a great question, Peter. And you can imagine, right? So we are hearing from a lot of clients that average customer age is north of 50 years compared to 38 years for an average US citizen. So I think there are few things which banks can do very differently. We typically classify them into 4 stages. The first one is, I think, in terms of acquiring customers itself. Right. So I think today there are a lot of capabilities to go and start using digital channels to go and augment that. Within those also, we use a technique called addressable media, right? So it's not going to Facebook and saying, give me, or I'm going to show this advertisement to everybody who is 25 to 45 years old in a particular zip, who is a fan of Pittsburgh Steelers, right? But starting to go and bring a lot of discipline that you already have in terms of your existing targeting capabilities, but then porting it over to digital channels. Because that's where we are saying, like, a lot of these younger people, they're not even reading the mailer, they're just trashing them away. But when you start giving them these messages on the channels where they are most engaged in, that starts creating a very different kind of profile, which starts coming to you and starts becoming your member. But then you also have to invest in a ton of capabilities around that as well, right? And then Richard talked a little bit about those, right? Instant decision is a core capability. Can you make the decision in a few seconds? When you look at a lot of fintechs, a lot of larger banks, they have actually changed the customer behavior expectation itself, right? Ability to do an eligibility check on before even you apply for a lending product, and that's almost becoming a de facto in many places, right? You need to go and develop those kind of capabilities. The third set of capabilities that you need to have are around digital fulfillment, right? You might be able to go and make the decision, but are you actually going and giving them the tools after that as well, right? When you apply for a credit card, you are approved. Can you go and activate it online? Or can you go and set up a lot of other features in terms of digital servicing? Do you have the right capabilities? And then going all the way even to your, I would say, collection behavior as well, right? And Jill talked a little bit about, like, a lot of people, if they're on hard times, they're expecting that support. And then one of the biggest challenges we have seen in this is basically accessibility for the member, right? Can they go and look at what options they have available? Can they go and pick up something for their own? So we typically ask them to invest in these areas itself to be able to basically create the features that these Gen Zs, millennials are expecting from a lot of the community FIs. And then on this decision of what you build, what you buy, how do you bring in partners, I think that becomes a question, a strategy question for each and every bank. But these are some of the things we do believe, I think customers are almost starting to expect from their community FIs, and then this is something where banks will have to keep investing in future.
Right. Yeah, that makes sense. Question here for you, Jill, specifically around digital strategy. How do you create a digital strategy when there is a lack of tech talent for execution? I imagine talking about you're a small IT team.
So we really haven't found the tech talent to be lacking. It's easy to contract out for it. It's more, again, the staff that's not intimidated by the technology than it is actually getting the tech talent. I haven't seen that as a barrier, but it does require likely some turnover of your team, because you have to achieve the culture that's going to be accepting of change. I mean, that's really what transformation is all about, is being accepting of change. And just because this is a digital transformation doesn't make it any less hard. And so you have to have a team that has the ability to accept and even drive change. So we focus a lot on culture, where we're reading books together and challenging, listening to different audiobooks together, challenging each other with case studies, so that we don't end up we can be more the Netflix rather than the Blockbuster. And so it's really getting that mentality shift that's so important. But the talent is out there from a technology. The skills are not hard to find. You don't have to necessarily hire that. And you want to hire the mindset so that you ensure that your culture can go where you want it to go.
Interesting. Very good point. So, Richard, there's one here for you. As a credit union, what can you do to push your core provider to integrate with a fintech solution that they do not support today?
Okay, I'm Chief Lending Officer, not Chief Technology
Yeah,
Officer, so
exactly.
I'll preface it with that. Hire a good CTO is one. No, just all kidding aside, is we've made a kind of a purposeful pivot on our technology architecture. And so it's really about creating more API flexibility. And so it's more about having our core provider agree to API development so that we can embed the appropriate microservices. So that's been the negotiation, is do we have alignment on sort of critical API integrations with probably a meaningful third-party provider where it makes sense for the core provider to leverage that API across multiple clients is one way to do it, but it by no means is easy. And I know that we've put a lot of investment, not just into the API microservices architecture, but also some middleware, so that some of that integration happens outside of the core. But it does get messy, but it can be done.
And just to jump in, so middleware, there's actual middleware, but you can also use some other software that's already integrating with the core as kind of middleware. If it has an open API, then you're able to kind of backdoor into integrations with the core that can be faster and cheaper than the actual, our core doesn't do API integrations. And so we have to go and actually have like a hardcore kind of integration whenever we're doing an update. So we just backdoor it through another third-party provider that's not really middleware, but we kind of treat it that way.
Interesting.
Okay. Open this up for anyone here. It's about marketing. For institutions that don't have an adequate CRM system, how do smaller credit unions or banks take advantage of the automation offered by fintechs to best direct their marketing focus?
I think I can start, but I think this is down the same point that I think all of the panelists have made, that whether you're a small bank or a credit union or a large bank, the expectation from consumers is that you get to know them, which means you start looking at all of their data. Even larger banks didn't really use banking data to its full extent when they were doing cross-selling or understanding. I mean, how many times do you get a mailer for a credit card from the same company that you have a credit card from? And so those kind of things with digitization are almost becoming, a taboo. So you have to know your data. You have to know your customer. And I don't think that part is outsourceable. And therefore, banks have to really take the step to, Vikas's point, to get all of that data into a data mart, organize it, and start thinking about relationship management, understanding them, giving them relevant tools, or you're going to have a run on your customers, because this data is now available through Plaid, et cetera, to everybody. So they also know your customer. So, there is no option now. Before, you were a community bank, credit union, you had members, they really didn't speak to anybody, you knew them well, but now everybody knows them or can know them because they give access to their data. So this is the whole dilemma. Now, the point is, again, the same thing, that I don't think you can come up to speed on CRM and 360 management all by yourself. And that's where I do believe this partnership is very important with the right set of companies, where you keep your core talent that can do the CRM, but the capabilities and functionalities and automation, the linkages, the governance and privacy governance needs to be automated and built in. And so that you don't make mistakes. And as soon as the CFPB and all of the other regulators are going to focus on smaller banks, they're already talking about 10 billion and above, and then it'll be going. So these are core capabilities that I think partnerships will certainly enhance, but keep your core people, grow your core team. And once you have an exciting technology and a strategy, I think you'll also be able to attract very talented people. I hear many people, why would somebody work with me when they can work for Goldman, etc.? I can guarantee you that the current generation is looking to help transformation, but they're not going to go where the leadership isn't ready to transform. To Jill's point, you have to have a leader who's excited, transforming, putting the right tools in place. Then if you want the tools, you can call me or Vikas, and we'll be there with all of our experience, or somebody else. But I think kids or younger generation is looking to make a difference. And I don't think they all want to go to the old big banks anymore, but they won't go to stodgy old thinking banks. They need newer thought process. And we have two great examples here. I would send my kids to Jill or Richard's organization in a heartbeat. And they're doing computer science and data science today, right? So that's what I think is the future, mixture of the two.
Right. Okay.
Yeah, I think you really have to be focused on progress, not perfection. I mean, there's lots of great customer relationship management tools out there. It doesn't have to be the full, 6-figure one. I mean, keep just taking steps forward. Don't feel like you have to be perfect at the end of your transformation journey this year.
All right, that's a good place to end it there, Jill. Thank you very much. Thank you, Manish and Corridor Platforms for sponsoring this fascinating discussion. Thank you, of course, to the audience for tuning in. Really appreciate your time. Have a great afternoon, everybody. Thank you.
Thanks, guys.
Thank you, everyone.
Bye-bye.
Yeah.